Hi, and welcome back to some more portfolio optimization. And today we have taken our risk system ARMS for a spin, and we're going to hack our ARMS to have some positions that we want to hedge. So our portfolio optimization is going to risk minimize using other position types. So this is a totally different portfolio optimization than the previous examples, which are more school book buy-side portfolio optimization. So what are we looking at? Well, first of all, we have coded some positions directly in code. So we have a set of fixed flows, we have a bond, and we have an FRN. And we assume that we have these with maturity 2021. The fixed flows are in euro. The fixed coupon bond has a 5% coupon and it's dollar based. And we have a SEK based FRN with a fixed margin of 22 basis points. And all else equal, we are calculating historical value at risk using 500 days historical values, and it's all set to calculate in krona. So we get interest rate risk and FX risk from our little fixed income portfolio. And again, what is it that we want to do? Well, we have made a target function that is the value at risk of this portfolio. It's actual conditional value at risk or expected shortfall calculated on the 99 percentile or quantile. And we say that we want to have this risk as low as possible. And how do we do that then? Well, we add two FX forward positions, both 1 month in maturity, and we assume that we get to trade $1 SEK and €1 SEK forward with 1 month maturity. But we don't know how large these positions should be. So we have a variable notional for these both positions. And this is what we're going to optimize over. So with this target function, with variable FX forwards, dollar SEK and euro SEK, we can now use our Downhill-Simplex nonlinear solver without any constraints, and just try to minimize this function and hope it's fairly convex. So we take the VaR function with the P, with the starting values minus 100, minus 100, and we let this work, and we return the optimal values if it finds the fitted parameters P. And then we can test this by entering these into the function that's connected here. So we compile, and now it's running. And what is happening now is the optimizer is actually calling the VaR. And since this is such a fast VaR engine, it will do a 500-day historic calculation and calculate the CVaR, expected shortfall, for each iteration that the Downhill-Simplex is running. So we can see we got a result, and then we can see that the first result will be the volume of dollar SEK, and the second will be the euro SEK FX forward notional. And if we would have no hedge, our expected shortfall 1 day out of 100 would be 331 kroner, and having our optimized level, we need to copy. We can see that we get 112. So obviously the 112 is our minimum reachable expected shortfall level using these hedges. And we can see from this 3D plot that there is a minima in terms of varying different sizes of these hedges. So this is actually just a plot of varying the FX Forge in the both currencies. So what has happened here? Well, now we've actually taken FX Forge that are larger than the exposure. Perhaps we don't want to minimize just our VaR, but we want to just minimize the VaR coming from the currencies. So we have then a filtered VaR set, and then we can optimize the VaR coming just from FX. So we rerun this and see if we get a fit. And I think we're going to have a fit with a little lower notionals. So we're not going to go quite as short in these forward positions. And if we would enter these and see how they have altered our VaR, we can see that we get a VaR number of exactly 0. And this is of course because we can now completely hedge the FX exposure, since we're calculating VaR only coming from FX. If we then have a dollar SEK, we can exactly compensate for that VaR. So we can see that the optimal levels of these FX forwards would be the ones that totally vanishes the currency position. What could we do more? Well, we could actually remove the euro hedge and add interest rate cap in euro, and then again to see the volumes of dollar hedge and this interest rate cap that we would need in order to minimize VaR. So this would actually go for any type of instrument that we could think of to hedge our portfolio in terms of minimizing the expected shortfall. And let's see if we can find an optimal solution. Yes. So obviously now we have a different behavior of the VaR, and we can see that we need to go long this cap and short 2,000 of this dollar. And the dollar is probably now compensating for not having the euro, and the dollar and euro versus the SEK is correlated. So we can see that using these levels, we have expected shortfall of 94 kroner. This is the minimum level of expected shortfall we can get by buying, selling and buying these two instruments. So this has been an example of how to actually hedge a real portfolio of fixed income instruments in terms of FX, or just minimizing the risk of this portfolio and calculating the optimal hedges. Thank you very much.